Welcome back, everyone. We're diving into some fascinating stuff today. We're going to be looking at the Indian stock market in 2025.
Oh, interesting.
Yeah, specifically through the lens of this annual newsletter called Seeing the Glass Half Full.
Okay, I like the sound of that already.
Yeah, the title kind of gives away the optimistic spin, huh?
It does, yeah. It does, especially considering how crazy the market's been recently.
For sure. And you know what's really interesting is the author of this newsletter.
Oh, yeah.
Yeah, it's Ravi Dharamshi.
Oh, wow. The ValueQuest guy.
Yeah, founder and CIO of ValueQuest. So, he's got the experience to back it up.
Definitely.
So the big questions we're going to be tackling today, is it the right time to buy in the Indian market right now? What's with all these FIIs pulling out? And how's India going to grow with, all the global slowdowns and conflicts happening?
It's a lot to unpack, that's for sure.
Yeah, there's a lot going on. So starting off, the newsletter does acknowledge what a crazy year 2025 has been already.
Right, it wasn't exactly smooth sailing.
Not at all. Over 60 elections worldwide, including big ones in the U.S. and India, obviously. We've got the conflicts in Ukraine and Israel-Palestine still going on. And, that whole era of easy money policies, that's over.
Yeah, it feels like a completely different landscape now.
It really does. But here's where Dharamshi gets interesting. He brings in this concept from Charlie Munger.
Oh, yeah.
Invert, always invert.
Right, that mental model. I love that one.
Yeah, so instead of looking at all the bad stuff and asking, is this a bad time to invest?
He's saying, flip it around.
Exactly. He's saying, ask yourself, is this the absolute worst possible time to invest?
Okay, I see where he's going with it.
That's a total mind shift, isn't it?
It is, yeah. It forces you to think differently about the situation.
And then he goes on to argue that historically, very rarely has it been the best strategy to either stay completely in cash or to go all in.
So trying to perfectly time the market, even in all this chaos, probably not the best idea.
Yeah, it kind of reminds me of that Peter Lynch quote, more money has been lost trying to anticipate corrections than in corrections themselves.
Absolutely.
Yeah.
And I think Dharamshi builds on that really well. He stresses the importance of, taking a long-term view, especially when you're investing in India and, betting on those companies.
Right. Ride out those short-term storms. Focus on the long game.
Exactly.
Now, okay, here's the big question that everyone's been talking about.
The elephant in the room.
Yeah. The FIIs, the foreign institutional investors, what's the deal with them pulling out of the Indian market?
Right. It's been all over the news.
How does the newsletter address this? Because it seems like everyone's kind of freaking out about it.
Well, he tackles it head on, and this is where things get really interesting. He acknowledges the record outflow of FIIs, but then he points to something else. The domestic institutional investors, the DIIs, they've actually been buying.
So are we seeing a shift here? Like maybe, domestic investors are feeling more confident, and that's going to lead to less volatility caused by those foreign investors.
It's definitely a possibility, and the newsletter adds to this by saying that similar outflows are happening in other emerging markets.
So is it maybe less about India's performance and more about just a general global trend?
Could be. And there's one more point he makes about the FIIs. The quality of their money, it seems to be improving.
What does that mean exactly?
Well, it's moving away from that speculative hot money.
Yeah.
We're seeing more long-term investors coming in, like sovereign wealth funds and pension funds.
Interesting. So potentially more stability for the market.
Yeah, could be. I mean, these long-term investors, they're less likely to freak out over those short-term ups and downs.
Right, which could help even things out a bit.
Exactly. Now, the next big thing is obviously the global economic slowdown. It's everywhere you look.
Doesn't exactly paint a rosy picture.
No, but the newsletter doesn't ignore it.
Oh, good.
Yeah, he acknowledges the potential headwinds.
Yeah.
But he also emphasizes, that India's internal macroeconomics are actually improving, and they've got flexible policies.
So they've got some wiggle room to adjust as needed.
Right. They've maintained some really impressive fiscal discipline, which actually might help them transition from a deficit to a surplus economy.
Wow. That's a big deal compared to other economies struggling with debt.
Huge, yeah. And Dharamshi actually brings in some wisdom from Howard Marks' book, Mastering the Market Cycle. Marks says, and I quote this, "We may or may not be in a good environment, but we are certainly in an environment that's changing."
I like that. Prepare for change, but don't let fear control you.
Yeah, adaptability is key.
Exactly.
And he goes on to argue that India, with its growing service sector and its potential to, become a manufacturing powerhouse, is actually pretty well positioned to adapt and thrive in all of this.
So maybe there's a silver lining after all. But what about all the geopolitical uncertainty? Ukraine, Israel, Palestine, and all the other stuff we can't even predict? How does the newsletter deal with that?
He really emphasizes the importance of self-reliance,
Hmm.
especially for resources and energy. These conflicts, they highlight just how vulnerable you are if you depend too much on other countries for those essential things.
So basically, energy independence is more crucial than ever.
Absolutely. And this ties in perfectly with that whole mega trend of energy transition.
Right, and India has been really pushing for renewable energy.
Yeah, they've got ambitious targets for 2030, like 500 gigawatts of non-fossil fuel electricity. That's going to create huge opportunities for companies working in that sector.
It's like everything's pointing in that direction.
It really is.
The conflicts, the need for energy independence, and the global focus on sustainability.
It's a perfect storm.
Now, just quickly, before we move on, there is one thing the newsletter mentions that's a bit of a wild card. The possibility of Donald Trump taking office again.
Oh, wow. Yeah, that would definitely shake things up globally.
Right, and it'd have implications for trade and geopolitics, for sure. But the newsletter doesn't go into specifics.
I mean, it's still a bit early to say what the impact would actually be.
Yeah, it's a big question mark.
Definitely something to keep an eye on. But now, let's talk about something a little more concrete. This is really interesting. Dharamshi identifies what he calls a modern economic troika that's driving India's growth. He says it's made up of real estate, private capex, and the consumption cycle. And he thinks these three things, with the help of some strong macroeconomic policies, will really push the Indian economy forward.
Okay, that's a really interesting way to think about it. It's a new perspective on what's driving growth in India.
Definitely.
So let's break this down a bit. What about real estate? Why is it so promising right now?
Well, a major factor is, that urbanization boom that's still going on in India. The urban population is expected to explode in the next few years, which means massive demand for housing and infrastructure.
Millions of people moving to the cities. That's a huge market for real estate developers.
Absolutely. And on top of that, the government's been pushing hard for infrastructure development.
You mean like metro expansions, high-speed rail, better highways?
All of that.
Yeah.
And then we've got those encouraging signs like GST collections on building materials going up and relatively low unsold inventory levels.
So it sounds like there's a good balance between supply and demand.
Yeah, which is good news for investors worried about oversupply and those potential price bubbles.
Okay, but what about financing? Are banks lending to developers and buyers?
That's another positive sign. We're seeing more credit flowing into real estate. So banks are clearly confident about the sector's growth potential. We're even seeing a big jump in office leasing, which suggests that businesses are expanding and, putting down roots.
So real estate is definitely looking good, huh?
It is, yeah. And then you've got government initiatives like PMAY, the Pradhan Mantri Awas Yojana, which aims to provide affordable housing. That's both addressing a social need and boosting demand.
It's a win-win.
Exactly. It's really interesting how all these things connect. Urbanization drives the demand, infrastructure development helps meet that demand, and then government policies create a supportive environment for growth.
So real estate seems like a safe bet for driving economic growth, right?
It's definitely a strong contender. Now let's talk about that second engine of growth, private capital expenditure. Dharamshi says it's showing signs of life after a bit of a lull. What's behind this resurgence?
Yeah, why now? And what's driving this renewed interest in investment?
Well, for the past few years, it's been the government leading the capex charge, especially during the pandemic recovery. But now, with elections behind us and a renewed focus on, fiscal responsibility, the government's shifting its spending priorities. They're looking more at things like housing and water infrastructure.
So they're making space for the private sector to step up and take the lead.
Exactly. And there are a few signs that the private sector is ready and willing to do just that. For one, capacity utilization in the industrial sector is getting pretty high. It's hovering around 75% to 80%, getting close to that 80% mark that triggered the huge capex boom we saw back in 2003 to 2007.
Just to clarify for our listeners, what exactly does capacity utilization mean, and why is it so important for private capex?
Sure. It basically means how much of a company's or an industry's existing production capacity is being used. When it gets up around that 80% level, it means companies are getting close to needing to invest in expanding their capacity.
Oh, I see. So it's like a measure of how much more they can grow using what they already have. Once they hit that 80%, they have to invest in new facilities and equipment to keep up with demand.
Exactly. And that's what we're seeing in India right now.
So they've got the need, but do they have the money?
That's the thing. Corporate balance sheets in India are looking really healthy right now.
Yeah.
Their debt-to-equity ratios are super low, which means they're not carrying a lot of debt, and they've got the financial wiggle room to invest in expansion.
Okay, so they have the capacity, the money, and the incentive to invest. It sounds like all the pieces are falling into place.
They really are. Plus, corporate profits are also on the rise, which just adds fuel to that fire.
Okay, but what about those PLI schemes, the production-linked incentive schemes? I've heard those are a big deal.
Yeah, they're definitely helping to attract investment, especially in sectors like electronics manufacturing, pharmaceuticals, and renewable energy.
So they're basically giving companies financial incentives to produce more and export more.
Exactly. And that's helping to create whole value chains within India, which is attracting foreign investment and boosting exports. It's a smart way to reduce dependence on imports and grow domestic manufacturing.
So all in all, it sounds like the case for private capex is pretty strong.
It's looking good. And remember, that multiplier effect of capex, right? Every rupee invested in capex multiplies its value throughout the economy.
Okay, before we go on to the third engine, though, I'm sure some people are thinking, hold on, you've been talking about all these positive things, but what about the consumption slowdown? That doesn't sound so good, right?
Yeah, it's a fair point. And the newsletter does address this head on. He acknowledges that consumption has slowed down, but he says it's due to temporary factors.
Oh, okay. Like what?
Well, one of the main things he points to is the extended Shraddh period this year.
For those who don't know, can you explain what that is?
Sure. It's a 16-day period in the Hindu calendar dedicated to honoring ancestors. During this time, a lot of Hindus avoid making big purchases or celebrating. It's a time for reflection and spiritual things.
So not exactly a time for going on shopping sprees.
Right. And this year, it just so happened to coincide with a really long monsoon season.
Which probably put a damper on festive spending.
Exactly. So the newsletter argues that it's more of a blip than a long-term trend.
So the underlying drivers of consumption in India are still strong.
Exactly. We'll get into those more when we talk about the consumption cycle as the third engine of growth.
Okay, that's something to look forward to in part 2 of our deep dives. Okay, so we've been talking about Dharamshi's modern economic troika and how it's driving India's growth. We started with real estate and saw some promising signs there. Then we looked at the revival of private capex. But now let's dive into the third part of this troika, the consumption cycle. This is where things get a little tricky, right? We talked about that recent slowdown, but the newsletter suggests it's more of a temporary blip than a sign of trouble.
Yeah, I think you're right. The consumption cycle is where, people's feelings and the actual economic situation really meet. And even though the latest data might show a dip, the newsletter is pretty optimistic about the long-term picture for consumption in India.
Okay, that's good to hear. So what are the main things driving this optimism? What makes them think consumption is going to be strong in India?
Well, the biggest factor is definitely the rise of India's middle class. They're projecting it'll reach something like 715 million people by 2030, 31.
Wow, that's a lot of people.
It is. And it's not just about the numbers. It's about what it means for spending power. More people will have the money to buy things beyond just the basics.
Right, so discretionary spending goes up, people have more choices about what they buy.
Exactly. And as incomes rise, so do aspirations. People want to improve their lives, invest in their kids' education, travel, try new things.
It's not just about buying more stuff, it's about buying better stuff.
Right.
Yeah.
Upgrading to better quality products, better experiences. And we're seeing this reflected in the growth of retail credit, too.
Like, more people are using credit cards and taking out personal loans.
Exactly. It shows they're confident about their future income, and they're willing to borrow to buy the things they want.
So they're not just spending what they have now, they're spending based on what they expect to earn in the future.
Right. It's a sign of optimism about the Indian economy's long-term prospects. And then there's the auto sector. Demand is booming there.
Like new cars.
Yeah, passenger vehicle sales are hitting record highs. Part of it is that rising middle class, wanting to own cars as a symbol of, moving up in the world.
It's interesting how a car can become a symbol of economic progress.
It is. And it's not just happening in the big cities. We're seeing rising car ownership in smaller towns and rural areas, too. It's a sign of broader economic empowerment.
We also can't forget about the digital payments revolution that's been happening in India. I mean, it seems like everyone's using UPI or other digital platforms now. How does that factor into the consumption story?
Oh, it's been huge. It's not just about convenience, it's about making the financial system more inclusive.
Mm.
People who couldn't access traditional banking before can now participate in the digital economy. They can shop online, use financial services, all of that.
So it's not just about spending more, it's about empowering consumers and giving them more control over their finances.
Exactly. And this digital infrastructure is also helping to formalize the economy, making it more transparent and efficient. Less reliance on cash, more digital records, which helps with financial planning and analysis.
It's really fascinating how technology is changing the way people spend and manage their money.
It is. And this is all happening with a young and tech-savvy population. India has one of the youngest populations in the world. They're early adopters of technology, comfortable with online shopping and digital payments, more likely to spend on experiences and lifestyle products.
It really does seem like the perfect combination of factors for strong consumption growth. A growing middle class, rising incomes, easy access to credit, digital payments, and a young population that's comfortable with
Yeah,
technology.
exactly. And even though there might be ups and downs in the short term, these are long-term structural factors that should drive consumption growth in India for years to come.
That makes sense. So despite those recent hiccups, the consumption cycle seems like it'll be a strong driver of India's economic growth. Now, let's step back and look at the big picture. We've explored these three engines of growth: real estate, private capex, and the consumption cycle. They all seem to be pointing in a positive direction, but are there any potential risks or challenges that could derail this growth story?
Well, no economy is completely immune to risks. The newsletter acknowledges that there are external factors, like global slowdowns or geopolitical problems, that could impact India's growth.
Right, we talked about this earlier, but what about internal challenges? Are there any things within India that could hold it back?
One of the key challenges the newsletter highlights is the need for continued structural reforms. India has made progress in areas like ease of doing business and infrastructure, but there's still work to do to create a more efficient and competitive economy.
Can you give us some examples of what kind of reforms are needed?
Sure. One area is the labor market. India's labor laws are complicated and often seen as a barrier to job creation. Making it easier for businesses to hire and let go of workers could boost employment and economic growth.
So, creating a more flexible labor market that can adapt to changes in the economy.
Exactly. Another area is agriculture. It employs a lot of people, but productivity is low. Reforms that encourage modernization, technology adoption, and better access to markets could really transform agriculture and increase rural incomes.
That's important. If a big chunk of the population is stuck in low productivity agriculture, it can drag down the whole economy.
You're absolutely right. Improving agricultural productivity is key for inclusive and sustainable growth. And then there's education and skills development. India has a young workforce, but there's a gap between the skills employers need and what young people are learning.
So it's not just about having a lot of workers, it's about having workers with the right skills for a modern economy.
Exactly. Investing in education and skills development is crucial to make sure India's young population can contribute to economic growth and share in its prosperity.
It seems like there's a lot of potential, but also some real challenges that need to be addressed.
Right, and the newsletter doesn't pretend these challenges don't exist.
No.
It's not about being overly optimistic, it's about recognizing both the good and the bad.
So, cautious optimism, I guess you could say, seeing the potential, but also acknowledging the work that needs to be done.
Exactly. And that brings us back to one of the main themes we've been talking about, having a balanced perspective, not being overly optimistic or overly pessimistic.
Understanding that investing in the Indian market is a journey, not a quick win. There will be good times and bad times, but the overall direction is positive.
I like that. Now let's talk about the psychology of investing. The newsletter spends quite a bit of time talking about how pessimism can be really appealing, but also really misleading for investors.
I think a lot of people can relate to that. It's so easy to get caught up in all the negative news, especially with how much doom and gloom we see every day.
It is. And we talked about Morgan Housel earlier, and he's really good at explaining this. He says pessimism often pretends to be intelligence in the investing world. Like being negative makes you sound smarter.
Yeah, like the pessimist is the wise old owl who's seen it all, while the optimist is the naive fool who doesn't know what's coming.
Exactly. But Housel reminds us that the market has consistently gone up over the long term. It's gone up through wars, recessions, all kinds of crises.
So if the market has always gone up in the long run, wouldn't that suggest that optimism is a better strategy than pessimism?
Well, it's not quite that simple. True optimism isn't about ignoring risks or pretending that nothing bad will ever happen. It's about understanding that bad things do happen, but they're usually temporary setbacks in a larger story of progress.
It's like they say, the stock market climbs a wall of worry.
Exactly. And he also makes another good point. Pessimism often leads to action, while optimism requires patience. A pessimist tells you to sell, get out, protect your money no matter what. It's a much more active, attention-grabbing approach.
It's that fight or flight instinct, right? We feel threatened, so we want to do something to escape the danger.
Precisely. And that might feel like the right thing to do at the time, but it can often lead to selling at the worst possible time and missing out on the recovery that comes later.
It's the classic investor mistake. Buy high, sell low.
Exactly. Optimism, on the other hand, often means doing nothing, just staying the course and trusting that the market will bounce back eventually.
It's about having the discipline to ride out the storm and knowing that the long-term trend is on your side.
Precisely. And this ties back to what the newsletter says. Successful investors are both opportunistic and optimistic. It's about finding that balance between being cautious and being patient, taking advantage of opportunities when they come up, but also staying invested for the long haul.
So it's not about blind optimism or reckless pessimism. It's about being strategically optimistic, seeing the opportunities even when there's uncertainty, and having the patience to let those opportunities play out over time.
That's it exactly. Now, the newsletter also talks about market corrections, those times when the market drops sharply and everyone starts to panic.
Ah, yes, those dreaded dips that make us second-guess everything.
Right. But the newsletter says corrections are a normal part of how the market works. They don't always mean a crash is coming.
Okay, but how do we know the difference between a normal correction and a full-blown crash? What should we be watching out for?
The newsletter gives us a few guidelines. It points to 5 things that usually signal a bubble that's going to burst. A peak in the economic cycle, peak earnings, peak valuations, peak fundraising, and peak leverage.
So when all those things line up, that's when we should be worried.
Yeah, that's when the alarm bells should be going off. And right now, the newsletter says that only valuations have peaked in certain sectors.
So we're not in a full-blown bubble yet, but it's a good reminder to be careful about what we invest in and avoid those areas where valuations have gotten out of control.
Exactly. It's about being smart with your investments, not just chasing the latest hot stock. It's about doing your homework, understanding the businesses you're putting your money into, and focusing on companies that have strong fundamentals.
It's about being an investor, not a gambler.
Precisely.
Mm-hmm.
Now, let's talk about some specific sectors and trends to watch in 2025. What does the newsletter say about areas with good growth potential? One of the big ones he highlights is the energy transition. India has set some ambitious goals for renewable energy, aiming for 500 gigawatts of non-fossil fuel electricity by 2030. That's going to drive a lot of investment in things like solar and wind power, creating opportunities for companies in that space.
That makes sense. It fits with everything we've been talking about, the geopolitical turmoil, the need for energy independence, and the global focus on sustainability.
Exactly. And India is in a good position to take advantage of this trend. They have plenty of sunshine and wind, a growing market, and a government that's committed to clean energy.
So energy transition is definitely one to watch. What else is on the radar?
He also points to the infrastructure sector. It's going to benefit from the government's big spending plans. We already talked about the investments in railways, highways, and metro systems, but there are also opportunities in things like water infrastructure, power transmission, and urban development.
So it's not just about building roads and bridges, it's about creating the infrastructure needed for a modern economy to grow.
Exactly. And these projects not only create jobs and boost the economy, but they also improve the quality of life for a lot of people.
So it's a win-win for everyone involved. What other sectors does the newsletter mention?
He also talks about healthcare. India has a huge and growing population, and the demand for good healthcare is increasing fast.
As people earn more and become more health conscious, they're willing to spend more on healthcare. That makes sense.
That's right. And there are opportunities all across the healthcare sector, from hospitals and clinics to pharmaceuticals and medical devices.
So it's a broad sector with lots of room for growth.
It is. And the government is also promoting healthcare innovation and access through programs like Ayushman Bharat, which is the biggest government-funded healthcare program in the world.
It's another example of the government and the private sector working together to meet a critical need and unlock economic potential. What about technology? India's been making a lot of noise in that space.
He definitely mentions the technology sector. India's tech scene is thriving, with a ton of talented engineers and entrepreneurs.
And with the digital payments revolution we talked about, India's really becoming a leader in fintech.
Absolutely. And all of this is fueling growth in areas like e-commerce, digital entertainment, and online education.
It's not just about software and IT anymore. It's about using technology to change every part of the economy.
Right. And with India's young population and their comfort with technology, there's a lot of potential there.
It's impressive how India is using technology to jump ahead and create a more inclusive and innovative economy.
It is. But beyond these specific sectors, the newsletter really stresses the importance of focusing on high-quality companies with strong fundamentals.
So it's not about chasing the latest fad. It's about finding companies that are well-run, profitable, and have a real competitive edge.
Exactly. And that means doing your research, understanding the businesses you're investing in, and looking beyond the hype to see their long-term potential.
It's about being a smart investor, not just someone who follows the crowd.
Precisely. And the newsletter reminds us that even the best companies can have setbacks and ups and downs in the short term.
That's where the patience and optimism come in.
Exactly. It's about having the confidence to stay invested even when things get rough, believing that strong companies will eventually deliver value over the long run.
It's about being a long-term owner, not someone who's just trying to make a quick buck.
Precisely. And this takes us back to one of the main ideas we've been talking about, the importance of a long-term optimistic view when you're investing in the Indian market.
So it's not just about buying stocks, it's about buying into a story, a vision of India's future.
Exactly. And that story is about growth, innovation, resilience, and people reaching their full potential.
It's a story that's still being written, and it's a story we can all be a part of. It really is incredible to see how India's story is unfolding and all that potential that's just waiting to be unlocked. This deep dive into Ravi Dharamshi's newsletter has given us such a fresh and interesting take on the Indian market in 2025.
I agree. It's been a really fascinating look at things. We've covered so much ground, from the market's volatility last year to why a long-term and optimistic outlook is so important for investors.
And we also got into those three key drivers of growth that Dharamshi talked about: real estate, private capex, and that consumption cycle. And we looked at what's making them tick, what's giving them that momentum.
Yeah, we didn't shy away from those potential challenges either, like the need for those structural reforms and how, pessimism can really mess with our judgment.
I think throughout this whole deep dive, we've uncovered some really valuable insights from Dharamshi's newsletter. What really resonated with you?
What stood out to me the most was the emphasis on finding that balance. It's not about being blindly optimistic or, on the other hand, letting fear and pessimism take over. It's about recognizing that there are going to be opportunities and challenges.
I totally agree. It's about navigating the market with that informed optimism, knowing that those ups and downs are just part of the journey. So for our listeners out there, what are some of the key takeaways from all of this? What can they actually apply to their own investment decisions?
Well, one of the most important things to remember is the power of long-term thinking. Don't get caught up in all the noise and those short-term swings in the market. Instead, build a portfolio that you're comfortable with, that matches your risk tolerance and your goals. Remember, staying invested, even when things feel uncertain, that's often the key to getting those long-term rewards.
That's such a good point. It's so easy to panic when the market dips, but history shows us that staying the course usually pays off in the end. What else should our listeners keep in mind?
Understanding the fundamentals is crucial. Don't just chase the latest trends or get caught up in the hype. Do your research, get to know the businesses you're investing in, and look for those companies with strong leadership, solid finances, and a real competitive edge.
So be an investor, not a gambler.
Exactly. And remember, corrections happen. They're normal. Don't freak out when the market dips. See it as a chance to rebalance your portfolio, maybe even snag some undervalued stocks.
Those are some really great tips. And it all comes back to that idea of being both opportunistic and optimistic, right?
It really does. And I think that's a powerful message for everyone.
Absolutely. As we wrap up this deep dive into the Indian market, I want to leave you with one final thought. How do you see the glass? Half empty or half full? And how does that outlook shape your investment choices?
Keep learning, keep asking questions, and don't be afraid to challenge your own assumptions.
Because as Dharamshi reminds us, India's story is still being written,
Yep.
and we all have a chance to be part of it. Thanks for joining us.
Thanks, everyone.